So as the current head, as the global head of ESG and sustainable finance strategy at Jefferies, I have a pretty unique vantage point from which to see how both investors and corporates are evolving on the topic of sustainability. So Jefferies is a global investment bank. We are a top 10 investment banking business globally. And what that means is that we sit in between investors and corporates and between investors and governments and help those who are seeking capital to meet and to be matched with those who provide capital. And when you do that, you actually see how the system works in a little bit more detail. On a daily basis, we are engaging with the world's largest investment firms, trying to advise large pools of capital on what are the most significant ESG-related risks and opportunities for their investment processes. At a very practical level, that means advising a portfolio manager who buys public equities, what is the fair price of the common stock of a oil and gas company, given what we know about the long-term demand of oil and the potential stranded asset risk. It means advising an analyst at a hedge fund, how do they better price the human capital and corporate culture risk of a company that has poor corporate culture and has a toxic corporate culture, which could lead into a tail risk event. It means engaging with a private equity investor who is thinking about what is the right way to put and install a governance program in a portfolio company to ensure that workers and executives and shareholders all have an appropriate voice in decision making. And we do that through content. And that's on the investor side. And then on the corporate side, we are advising the largest companies in the world to the smallest companies in the world on what do they need to do to be a company that is aligned with ESG principles, with ESG goals, and so on and so forth. And that means everything from talking to the world's largest oil and gas companies on how they should diversify their businesses, how will the capital markets reward them for investments in hydrogen versus investments in carbon capture versus investments in solar and wind versus investments in renewables, to advising a small company in the industrial sector that is going public that needs help thinking through their disclosures, trying to understand how do they wrap their arms around all the various reporting requirements that are coming down from the regulatory world, that are coming down from investors, desires that are coming from customers and other stakeholders, and how do you find a balance between what investors are looking for, what regulators are looking for, and what is actually possible to put together for a smaller mid-cap size business. That job, as you can imagine, as I've just highlighted, means that you are using every different faculty of your own brain. And more than anything, you are relying on the great minds of the academic world, of the scholar world, and of practitioners in different fields to advise you and support you in these efforts. And over the last year and a half since I built out this effort at Jefferies, we have come to really admire the work of scholars like Professor Shiva Rajgopal at Columbia Business School, whose work on accounting and the various challenges and shortcomings of our accounting system has been really unbelievably helpful for us as we think about how do we best navigate these issues for our clients.
Aniket, you're both an academic and a practitioner in sustainability. What would you say are the most interesting unanswered questions?
As you rightly said, I am both an academic and a practitioner in the field of sustainability, and particularly in the field of finance and sustainable development. And I think there are several unanswered questions that the academic community could do excellent research on and further their excellent research on, and also would be of practical significance to all of us in the financial industry. Let me highlight a few areas that I think would be of specific interest and specific focus. The first, and I think most important topic to really figure out is what is the simplest and clearest way to account for externalities that companies are creating, both positive and negative, on the broader economy. In some ways, I think the whole notion of sustainable development writ large and sustainable investing specifically is about looking at the system in a more holistic way. And it means that we have to look at not just the direct impacts of our of our economic activities, but also the things that we're not currently accounting for. Now, of course, the question of how do you properly account for positive and negative externalities is well known in terms of different methodologies, whether we're talking about carbon or whether we're talking about water, whether we're talking about unemployment and so on. But we haven't figured out a way to systematize it in a way that is simple enough for the broader capital markets to adopt and to inherit as part of their practices. So the first area that I would really focus on is what is a clear and simple way that the accounting industry and the reporting industry can better account for, in a standardized way, the externalities of a business into the real economy. A second area of focus that I think would be of extreme benefit to the financial industry is around intangibles. And specifically, figuring out a way of analyzing and reporting on a company's culture in a way that is systematic and can actually be part and parcel of formal and informal reports and accounts from companies. We all know that corporate culture is an incredibly important aspect of how and why companies are worth what they are. This is something we are seeing every day in our work here at Jefferies, engaging with companies in the tech space, in the biotech space, that are driven by human capital and driven by a innovative a culture that allows for breakthroughs to happen. But we don't have a systematic way of reporting on that currently, and certainly not one that is widely adopted or widely accepted in the business and financial world, let alone the accounting world. So I would say a second area of focus is to provide a specific set of guidelines and frameworks around the discussion of corporate culture for the business community, and allowing for that to be part of how the financial system thinks. A third area where I think we would see enormous benefits for all of us in the world of practice is the whole question around how do we better study carbon accounting, keeping in mind the various uncertainties around and assumptions that go into carbon accounting, as well as the determinative factor of geography in a company's carbon accounts. Right now, as you know, there's a big push around release of Scope 1 and 2 emissions from all publicly listed companies in the United States, and Scope 3 emissions for companies that have a net zero or a decarbonization goal. But those numbers are still built with lots of uncertainties and lots of assumptions behind them. And B, and very important to me, is that a lot of that data and a lot of a company's carbon footprint is actually driven by its geography and its geography of operations. And so, taken outside of context, understanding just seeing a company's CO2 footprint actually doesn't give you much information if you're trying to understand the company's strategy, if you're trying to understand how the company's carbon performance actually it is. So I think that this whole notion of carbon accounting and level setting with the broader industry around what it is, what it can achieve, and what it can't achieve, I think would be incredibly helpful for a greater amount of focus. The fourth area that I think is required, more scholarship is required, is around harmonization of global norms. and specifically, how do norms that are being developed in US, how do they blend with norms that are going to be created in Europe versus companies that are norms in China versus norms in India, and so on and so forth. The business world right now is struggling with what seems to be a further divergence in norms around reporting and around accounting in different major capitals of the world. And we need to have a better understanding of how do you harmonize that if you're a company? How do you harmonize that if you are an investor? And very importantly, what does history tell us about how a global set of norms develops when so much of what is being created in the sustainability space is being created at the national level? And I think this is an area where the accounting world could work very closely with historians and with political scientists to really do some interdisciplinary work around the establishment of international norms on issues related to sustainability and accounting. And then a final area where I think there should be a greater amount of focus from the community is what happens in terms of unintended consequences of different accounting systems. No one accounting system is perfect. Anytime you define a rule, there are a group of people who are going to try to break that rule. There are a group of people who are going to show the shortcomings of that rule, and so on and so forth. But as we now venture and think through a larger set of issues that companies need to report on, that investors need to analyze in their investment process, trying to understand from history, what do we learn about the unintended consequences of different reporting systems and accounting systems, and how do we take lessons from that so that our future work, as we enter into this new paradigm, minimize the negative unintended consequences that come from this project, I think would be remarkably helpful. Again, a useful collaboration, I think, between scholars of different disciplines.
Aniket, where do you see ESG going in the next 5 to 10 years?
Where do I see ESG going in the next 5 years? That's a really interesting question, and one that is on my mind a lot, and one that I'm trying to help my clients figure out. And by that, I have to first figure it out myself. If there were a few areas where I have slightly higher conviction about where things are going, they would be the following. So number one is on reporting. I think it's very clear that there is going to be regional divergence on reporting requirements for companies and reporting requirements from investment firms. The European approach in a way, using a taxonomy or creating a taxonomy of sustainable economic activities and using that to drive corporate reporting and therefore also drive the reporting of individual fund managers. That is a very different project than what the SEC here in the United States has started off the track that the US is going down. And I think which is a very different approach than what we are seeing in China, and which is a very different approach to the several national taxonomies that are being created all around the world around sustainability. So we're seeing a bifurcation or a multi-pronged approach towards reporting around sustainability. There are some who will say that's a good thing because that's going to create competition. We'll see which ones win. There are some who think that that's needlessly confusing. And of course, that's all happening at the same time as the International Sustainability Standards Board under the IFRS is really taking off. But in the world or in the debate around are we seeing convergence or are we seeing divergence, I'm in the camp of we're seeing in the short term, certainly in the next 5 years, continued divergence in approaches in reporting around the world. The second area where I think there is going to be a greater emphasis is around impact and impact-weighted accounts. And just in general, how do investors better understand a company's positive and negative social and environmental impacts on the world? We really think that that is the next chapter of the ESG space. ESG was mostly about risk analysis. It was about determining what are material ESG factors at the individual company level and then assessing that to better price a security. Impact is a different question. That is really looking at the question of what is a company doing that is positive for the world? What is a company doing that's negative for the world? And how do we better analyze that and make it part of our decision-making process? The term that is being used around this is the notion of double materiality. I think that whole space is going to get more and more attention and focus. And I think it's something that we really need harmonization. We really need more people thinking about how do you simplify that for the layman. And then the third and final space where I think I have a lot of confidence of where things are going to go is that in the real economy, the underlying environmental, social, and governance issues are only going to become more severe and higher on the minds of investors and regulators. And what that's going to mean is that there's going to be much more pressure on the system than even today to get these issues right. Despite all the growth in ESG, despite the growth in impact and so on, we have not yet seen a significant macro positive contribution of these efforts at the macro scale in terms of decreasing CO2 emissions, in improving inequality outcomes, et cetera, et cetera. And the pressures that currently exist around that are only therefore going to tighten and only going to increase. Right now, it's quite fashionable to think that ESG is on its way out, that the short-term energy crisis that we're in is going to mean that people will care less about the environment, and because we're entering in potentially entering a recession here in the United States, that people will care less about social issues. I don't believe that at all. I think all of that is only going to increase the pressures, which means we have to get all of this right. So those are some areas that I think, some places where I think that this whole space is going to go in the future. Thank you very much, and hope you have a great rest of the conference.